I think everyone, we have a go. We were just bamboozling our early attendees by having a conversation of green QE and other measures without actually having started. We'll bring that up during the conversation going forward. So today we have a webinar on the central banks and climate risk, which has been triggered by a fantastic new report from the Network for Greening the Financial System. There are two reports we're drawing your attention to today. There's the status report on financial institutions' experience from working with green and non-green and brown assets and potential risk differential. We're going to hear a bit more about that. And then a guide for supervisors about integrating climate-related risks. We have had an extraordinary experience in the last couple of years, arising from the work of the PBOC, the Central Bank of China, to green finance, and the work of the Bank of England and Banque de France and others in starting to consider climate risk. We've seen the G20 Green Finance Study Group bring together regulators, ministries of finance around the world to talk about these issues when China was the G20 leader. And then out of that discourse was formed this incredibly exciting organization. This organization that gives me hope in so many ways, which is an incredibly long title too, the Central Banks and Supervisors Network for Greening the Financial System. We are lucky today to have Morgan, who runs that organization, the head of the Secretariat. But what you need to know is that this is an organization of central banks from around the world, where the numbers just keep going up. I think, are we at 64 at the moment? Morgan, what's the total number of members?
66.
Oh God, every time I speak to him, it goes up. So what's amazing about this is that this is a forum for central banks and supervisors to discuss climate risk with an appreciation of the fact that there are substantial and real risks now that we have to start dealing with as a result of the discourse the last few years. And then more to the point, the network has been publishing a series of papers, interventions in the market, which, if you like, take the discussion forward. And that's what we're going to hear about today. Now, I'm of the view that the financial system is made up of a range of different intellectual streams about how we think about risk, how we think about what can be done, etc. One of the ways you influence the financial system, and one of the ways this will be influenced, is if you start at the top with what central banks think. That will cascade down to the market necessarily, because they need to provide leadership and guidance for us, but how we run the system. So what we're looking at here is the central banks of the world starting a intellectual leadership program to think about financial risk, which is already cascading down into how we think of our financial system going forward. So it's incredibly exciting. Morgan, thank you very much for joining us today. I should just add formally, Morgan is the Deputy Head of Financial Stability Department of Banque de France, the French Central Bank, and the head of the NGFS Secretariat. He's a long timer at the Banque de France, despite a little stint at Trésor for a while. We also have with us Joe Paisley. So this is another aspect of this incredible way climate change is now becoming embedded in our understanding of risk. Joe is the co-president of the GARP Risk Institute. I never remember what GARP stands for. You can tell us in a minute. But what you need to know is that this is the Global Professional Organization for Risk Managers. Got that, everyone? The Global Professional Organization for Risk Managers. And we have with us today the co-president talking about this and climate risks. Whoa, how this agenda has traveled over the last few years. She's had a very illustrious history. She's been the global head of stress testing for HSBC. She's been at the UK Prudential Regulatory Authority, and before that the FSA, and so on. And what I found intriguing is she's a master of philosophy and economics, important this time. And then we have Prashant Vaz, who's our fantastic head of policy at the Climate Bonds Initiative, leading our engagement with central banks and macroeconomic risks, and has got a potted history, a stint in Hong Kong working for the government and then WWF, a stint at the Nest Pension Fund in the UK as a head of analysis, and a stint as head of division of Office of Climate Change in the UK government, in the old DEC as it used to be called. So this is our lineup today. We're going to be talking about the report that we've seen coming out of the NGFS. There's also a report from GARP that Joe's going to alert us to us, but fundamentally we're talking about central banks and climate risk. Understand, we're in the middle of a crisis. We have to acknowledge this. This is not a crisis divorced from climate. This is a crisis that's involved pathogens jumping between species as a result of environmentally degraded environments. This is what's been predicted by the International Panel of Climate Change for the last 25 years. We will see a century of pandemics under climate change and other shocks, weather-related shocks, firestorms that cripple economies for a year. This is going to be the century of shock. This is going to have to be the century of resilience. So the lesson we're learning, the bitter and tough lesson we're learning now, is that the understanding what is resilient about our societies, our health systems, our economic systems, our financial systems is more complicated than we thought. It's a test case for us. It's a learning stage for us this year. As we deal with the mourning of people dying, the sad and tragedy of that, we have to analyze this and think about what are we going to do now to make our societies and our financial systems resilient in what will be many, many of these going forward. And we need to think of mitigation, because essentially the IPCC's target of 50% cut in emissions in 10 years, remember that, 50% cut in 10 years is what we're striving for to avoid catastrophic climate change, needs to be understood as inoculation against that catastrophic climate change. If we don't do it, the resilience agenda is going to be that much worse. So that's the background story. But today we're talking about where we're going with the risk discussion at central banks and supervisors. So thank you again for joining us. Morgan, I'm keen to get to start off with you, if I can. I know you've got a couple of slides. I'll move to one. Can you tell us what's going on, these reports? We've got the recommendations on the screen, but I'm also keen to know about the intellectual journey and what feedback you're getting from this intellectual journey.
Sure. Thank you, Sean. Can you hear me?
Beautifully.
Excellent. So first of all, thanks a lot for your kind words, and I hope we'll be up to your excitement about the NGFS. Maybe to begin with, let me give you, in particular for those who join us and do not necessarily know who we are, a few summary of last season 1 of NGFS. So you may remember in April 2019, the NGFS published a first comprehensive report, which was actually a compendium of the analysis that we had done. And in that particular report, we issued a number of recommendations. And in those recommendations, what we basically say is climate risk is a source of financial risk. For that reason, central banks within their financial stability mandate need to take that into consideration. It's not that they need to, but they have to. Otherwise, they're not discharging their financial stability mandate. So we published a report, and afterwards, a number of people came to us saying, okay, so your recommendations look good, but in practice, what do you mean? What do you bring to the debate, and what is your operational contribution to helping us fighting climate change? And for that particular reason, what we decided to do for season 2 of the NGFS is to focus on something much more operational, concrete, to create some tools that could be used by supervisors, central banks, and try to actually help in practice. And what you see today, the reports that we published last week, are the 2 first milestones in that journey. The first one, as Sean mentioned, is the guide on supervisory practices. So what we mean here is basically a compilation of all the best practices that we observed throughout the NGFS membership. As Sean mentioned, we are 66 members covering a variety of settings, emerging, developed countries, Europeans, non-Europeans. And so in the guide, what we did, we collected all the various experience of everyone. We have some specific boxes explaining what's happening in Malaysia, in Bangladesh, in Scandinavia, in the UK, in France. And what we try to say is, okay, let's pick up all this interesting feedback from the experience from the various central banks, and let's wrap them up in a report with some specific recommendations. And the objective is the following. The point is to say, you are a supervisor, you have no clue on how to get started with climate risk. well, just read the handbook, follow the recommendations, to take a look at the examples, and then you will learn quicker. It's not more difficult than that. And so in those recommendations that you have on the screen, well, as you will see, it's not rocket science, it's common sense. We suggest to follow a 5 steps approach, which is the one that was followed by most of the members within the NGFS. Not all of them have done all the journey, but at least it's certainly a right way to start. So the first step, of course, is to try to think, is climate risk material in my jurisdiction? Are my banks or insurance particularly exposed to that risk? Yes, no. Usually it's yes, I have to say. If that's the case, then you need to organize yourself so that you can deliver. And to do that, you need to recruit the right people, train them.
Morgan,
yep.
Can I just ask you a question about,
Sure.
You're looking at what different central banks are doing around the world.
Yeah.
I mean, what are you finding out about how people are doing this and how difficult it is? It's a common sense idea, but in practice, it's actually a little bit more complicated, no?
Yeah, you're completely right. Usually what they do in terms of organization, there are several ways of doing it. Usually what they do, they in particular in the emerging countries, they would resort to technical assistance that is provided, for example, by the World Bank or other programs. They sometimes refer to specific technical documents that could be published by a number of private sector organizations, the UNFFI documentation, the CBI of papers and deliverables as well. And
sorry, you mean there are people in central banks who are reading our papers?
Of course they do.
Big tick to
I
you.
know for a fact that the Bank of England does as well. We get regularly asked to come and present and talk to them about it.
Sorry, Morgan, we've got to grab every moment we can as a small NGO. So thank you for that mention.
Name droppers, please.
No, it's very useful. Please keep on doing that. No, what they do, they take as many deliverables and documents they go through as much as possible. Then they organize themselves. Well, there are several options. Either you do a sort of internal hub, a little bit like what we have at the Banque de France ACPR, at the Bank of England as well. You bring together various skills and experience. But you're right, it's not that easy. And the point is to say, if you take a look at what the others have done, then you would go quicker. And clearly, usually what the supervisors have been doing is starting by a qualitative survey. So they would send out a survey to their local banks or insurance and ask them about what they feel about their exposures. This is usually the first way to move forward. And then they would move to a more quantitative approach and ask them about figures, exposures, estimates. But usually it's not that straightforward. And this is precisely what this guide is about, helping them doing things quicker and with less operational troubles. And just to finish on that,
can I just ask you quickly?
Sure.
Can I just ask you very quickly?
Yeah.
I mean, what comes across from Joe's slides is that quite a few of the banks, especially in some of the European countries, I think the figures are something like 80%, quite a few of the banks are already been thinking about some of these issues for 2 years and more. Did you get any responses back from the survey saying, actually, we're doing this already, we want to go faster, quicker, can you help us?
Yes. So you're right. Then I will also include the second document on risk differential. In Europe, the situation is a little bit different because you have a number of banks which have been doing already quite substantial work. The problem here is more comparability because you get something from a specific bank which has used a specific scenario analysis or specific stress testing, which is not necessarily comparable to what you will get from another bank. And I would say in Europe, but Joe knows that much better than I do. In Europe, you need to manage a little bit the complexity of the various input that you get and try to see whether things are consistent, comparable or not. Whereas in other part of the world, then it's a little bit different. You start from not much. So it's really, you need to build something in some countries. In some other countries, you already have a number of quite sophisticated animals which have their own risk analysis techniques, and then you need to found a way to compare what is comparable. And to bounce back on that, this is something we observed in the status report on the risk differentials between green and brown assets. What we tried to do here is to collect a number of evidence because we wanted to go a little bit beyond this debate on green supporting factor or brown penalizing. So we said, look, let's not jump into policy part right now, but let's collect facts and figures and let's see what we have. And we've done that with 49 banks, 5 insurers, and at the end of the day, it was extremely difficult to compare because the definitions were different, time horizon were different, the data that we got was backward looking. So I would say our outtake from that was that there is certainly a need for us authorities to provide guidance and clarity on what we mean in terms of definitions, in terms of data gaps. And I guess in terms of takeaway from the 2 reports, this is the following. There are already quite a number of things that are being done. Much remains to be done, and there is a need for authorities and in particular legislators to start step in and provide a bit of clarity and guidance.
So, Joe, you had a stint at HSBC with this very substantial risk responsibility. Were you doing this? Was this part of it when you were there? I'm assuming you started the work on this.
We weren't doing climate-related stress testing. We were doing, at that point, macroeconomic capital stress tests. But one thing that was interesting is, and of course, having worked at the PRA as well, I was very heavily involved with designing stress tests for the UK banking system. But then when I was at the PRA, at HSBC rather, I got to see the PRA and all of the other regulators in their full glory. And I'm sure we'll come on to this, but one of the challenges you have when you're in a major global bank like HSBC is you're dealing with all of these different regulators. They're all doing something that should be similar, but they're doing it in very different ways. And it's extremely costly because it's fragmented. And I guess that's one of the challenges that the NGFS will have, is how do you roll this out in a way that it doesn't make it into one hell of a compliance exercise? All slightly different templates, different definitions, not harmonized. It has the potential to become, unmanageable for the firms. And that, of course, it's one thing when it comes to capital stress testing, but when it comes to climate, given the urgency of this and the need for a global view, I think it's even more imperative that the NGFS arguably is probably more ambitious than it is even now in terms of bringing all of those regulators together on the same journey to the same destination, rather than just saying, here's a broad outline, now go figure how you want to do it.
May I just ask you whether, when you were working at HSBC, which has obviously got large operations both in Asia and in Europe, did you find that the regulatory environments were quite different compared to different locations?
Yes. Yes.
In terms of their sophistication and...
In terms of, yes, and that's just for stress testing. It was bewildering, actually. And you've got some very major regimes there. So you've got, in the US, you've got the CCAR, DFAST, and they've got a particular approach. The Bank of England and the PRA had their own approach, which of course I helped design. So, I would say that was a pretty good one. Then you've got the EBA, the ECB, HKMA. I mean, they're all different. They really are. And it's interesting because you think, well, how different can they be? You're basically testing how much capital you need against a major downturn. How many different ways can you look at it? But no, it was extraordinary. It was very, very costly as well.
Morgan, I know you've given a lot of thought to this idea going forward. And in a sense, this is part of the extent to which finance is globalized, but our regulatory environments have not caught up, right? That's what we're talking about here. But we've got a pressing need now because of the risks coming through on climate change to kind of figure out how to sort this out so we can manage properly. What do you see as the prospects for progress? I mean, are you seeing appetite amongst central banks for greater coordination on this issue? I know you're putting out guidelines with an ambition about that, but I'm just curious about, shall we be hopeful about in this area? a greater standardization of approaches going forward, or is it going to be a tough journey?
Actually, the point that Joe made is quite key, and every time we meet with industry representatives, they really ask for more clarity, more consistency, and regulatory approaches. So here the point is, for us, it's a little bit tricky because we're not a standard setting body. We are, like our chair, Frank Ellison, likes to put it, we are a club of the willing. And we have no legal existence. We're not a legal entity. And so what we are producing is absolutely not binding at all. And in a way, we were set up probably because there was a little bit of a vacuum in that area. And so the question is, you already have some standard setting bodies like the Basel Committee, the FSB, IOSCO, and others. And in a way, it's up to them to define standards. It's not really up to the NGFS to do that, because if you want to do that, then you're not a club of the willing anymore. You yep. change your nature. You need to have some specific way of consulting with the industry. And I would say at some point there will be a need for clarification. And currently, as we see it, we are more here we are a little bit like trailblazers. We explore new things, we narrow down complexity, and then we hand over to the Basel Committee or to the others who are in charge of issuing standards. I know it's a bit theoretical right now, but the Basel Committee is progressively moving forward on that. They have set up a specific task force. So I hope in the future, everything we're doing now within the NGFS will be transferred somehow to the Basel Committee and will be turned into internationally agreed and consistent standards.
Well, Joe, that's a grounds for hope, I think, what he's putting us there, but it's going to take time. Let's pick up your other recommendations, Morgan, because we rudely yep. interrupted you with this little discussion, but thank you.
It's okay, it's okay. No, anyway, you can see them on the screen, so it's very basic. You need to find a way to identify the exposures, set supervisory expectations, and finally, you need to ensure a proper management of climate and environmental risks by financial institutions. So you see, it's not rocket science, but it's just a way to structure a little bit the approach. And of course, all the steps could be carried out all together or not necessarily following that order.
So we've got a clear set of guidelines coming through in terms of recommendations. We know that many central banks are doing it. And I'm going to say, Morgan, full credit to you, when I've been speaking to central banks across Asia, they've been telling us, which really cheered me up immensely, they've been waiting for these reports. And they already had an action plan flowing on from these reports about how they're going to apply them or look to application locally. So I know it's simple in a way, it might be common sense, but these are also seminal, I'm going to argue, going forward. And of course, the power of NGFS is not just the rule setting power, it's also the normative power of a discussion which brings everyone into the same tent and looks at it in the same kind of way. And that is a very important part of all this. So I might take you, I might take you to the next slide. Is there anything else this slide you'd like to draw our attention to before we move on?
No, I guess as for me, I'm quite happy. You told me, Sean, it's more like a discussion at the bar or together with friends. So I made my points and I'm happy to take questions later on in the Q&A. And I'm looking forward to listening to Joe.
So we might, Joe, I've pushed, do you want me to go back?
I don't mind. Yes, fine. Let's stay there. Let's stay there.
Okay.
Let's keep everybody
over to you,
dying to know what I'm going to say. I think actually in some ways, Morgan, just picking up that last point, in some ways it may be better that you're just a coalition of the willing at the moment because, you know, everybody is on a journey and we don't have all of the answers yet. And I think that brings me to the work we've been doing at GARP. So when I was reading the NGFS reports, and congratulations on getting them out. I mean, it's hard enough to coordinate across international boundaries, but let alone in a pandemic. And I thought they were really very valuable. But I thought there were huge parallels between what I was reading, the journey that you expect the supervisors to go on, and the journey that some of them are already on, and the journey that the firms are on as well. And so if we go now to the next slide, Sean, we've just finished and just published our second annual global survey of climate risk management at financial firms. And this was a survey with 71 firms, some of the biggest banks, asset managers, insurance companies, financial market infrastructure in the world. And what we found over the last 2 years really is it does start with the board. If you don't have the board thoroughly engaged, it's quite difficult to embed this in your strategy, risk management, BAU and everything. So there's a huge need for the board to understand their risks, to think about it. And the best firms that we're seeing at the moment, they do have very good conversations at the board because there's a commercial reality as well. There's a commercial imperative to understand this. It's not just about risk, it's about opportunities and missing out on those opportunities. Like the supervisors, I think the firms are trying to decide how to set up their climate risk functions. So, you talked about, should it be a hub and spoke in the supervisor? How do you link macro-prudential, micro-prudential, monetary policy, financial stability? Within a major organization, you've also got to work out, do you have a dedicated climate risk function, or do you embed it in your risk management? And what we're finding is most firms are choosing to just embed it. And that's because we tend to think of climate risk as a transverse risk. So it's going to affect your credit risk, your operational risk, your market risk. And you've got to work out how to embed it in those day-to-day processes. So it's better to kind of embed it and build up that expertise throughout your risk function. And then also, of course, in your frontline businesses as well, because the relationship managers in a bank have to have conversations with the clients about climate. So what you find is pretty soon, everybody's got to be talking this language. Perhaps not surprisingly, practically all of these firms think that climate risk is not properly priced. Not surprising given the challenges and the complexity of actually modelling the impacts on climate. And I think also it points to the difficulty of incorporating those longer term considerations within shorter term horizon of pricing models. And I think that that's something that we're going to have to work very hard to actually crack. In terms of that longer time horizon and the need for this forward-looking analysis, of course, scenario analysis and stress testing are the key tools. They do seem to be the hardest areas to crack. And I think that the next publication that the NGFS brings out on the reference scenarios will actually be really critical importance. And that's where, frankly, it doesn't matter if you're not a standard setter. Just issuing those scenarios will be incredibly important and very, very helpful. Just back to the sort of earlier HSBC nightmare, I would just be careful about creating multiple regimes of scenario analysis and stress tests. Because before you know it, you've got the reference scenarios coming out, and then every supervisor goes, oh, gosh, we better do some stress testing, and then you've got 100 different approaches, and it doesn't help at all. And as I say, I think climate is different from most of the things we look at. The report talked quite a lot about capital. I think, though, it's much broader than that. It's about pricing, product development, business strategy. Actually, it's beyond that as well. It's also about training and culture. It's going to completely transform many, many firms. And the ones that are really embracing this and developing new products are the ones that are going to get the most commercial advantage from that. But underlying it all, there's a huge need to build capability and awareness. And I'm sure that you're aware of that, not only in the supervisors, but beyond the kind of echo chamber of climate people who, all talk to each other in all these different conferences. We need to bring it out so that, boards, business people, HR, every aspect has some understanding of what's at stake here.
Joe, can I just interrupt for one moment, actually? Because, I mean, I did read the report, and I was really delighted to see the kind of depth of questions that you asked in it. One thing that struck me was that one of the issues was that the things that the banks thought was the biggest issue was really lack of certainty about regulations. Many of them actually thought that they were reasonably confident that within 5 years, they could actually develop the in-house expertise, do some of that kind of internal development itself. But what they were lacking was this, A, regulatory certainty, and B, the kind of metrics. And other thing that struck me was that only 15% of the survey results thought that within the next 5 years, climate posed a significant risk. So it wasn't so much that the metrics were not there. It was just that this tragedy on the horizon, it's still seen as being a long-term issue. And I think something like 70% of the banks said that they had set some kind of metrics, 50% had targets, but very few were changing their behavior as a result of these, the work that they're already doing. So I just wonder if you have any comments about that.
The first thing is, it's not just banks, it's across, the survey covers 43 banks, but also 28 other institutions like asset managers and insurance companies. And there's a huge range of maturity. And we don't have the chart here, but you can see from the very best who've really thought about this for well over 5 years. You know, they've embedded it, they've really thought very hard about it. And they will be much more confident in their strategy, whereas those that have just started, you know, they may not even know where they're going to go next. And so what you see is just a sort of maturity. People are just moving up, and the more they do, actually sometimes they do a little bit more work and they think, my goodness, this is much harder than we thought, you know, and they then become even more aware that they're not resilient. So you sometimes find that the firms that have just started are pretty confident, wrongly so. And then they come in the survey the next year and they're like, oh, actually, this is, you know, a bit harder. If we just move to the next slide, actually, I think we can pick up on that regulatory uncertainty point. This is my last slide.
Just before doing that, I just want to go back to the scenario planning for a minute. But for everyone who's joined since we started, this is the Central Banks and Climate Risks webinar from Climate Bonds. I'm the CEO of the Climate Bonds, Sean Kidney. This is being recorded. The recordings will be available very soon afterwards via climatebonds.net/webinars. And you'll be able to download podcasts on Spotify, Google, and Apple as well to share with your friends. So you'll be able to walk along listening to Joe talking about risk while you're having your exercise in the park at designated time. So please do go. And a little bonus feature we're giving you. This is the slide deck we're showing, but there's a longer slide deck that we're making especially available to you if you go to the webinars page afterwards, so you get more information and of course links to the reports. Just wanted to put that out there. On the scenario planning, Morgan, this is really a major landmark we're about to hit with these reference scenarios coming out. I can remember the conversations with Frank Elderson and others in the high-level expert group on sustainable finance a couple of years ago, where we had this aha moment when Frank, in one of his speeches, Frank is the chair of the Dutch Central Bank and also the chair of the NGFS, said, we can no longer look to the past to understand the regulations for the future because of the nature of what's coming to us. So the only real thing we can do now is start looking at scenarios, different scenarios for the future, and think accordingly, right? That was an intellectual pivot moment, I think, in terms of thinking about how we tackle this. And now you're bringing out reference scenarios and going back to this issue of the normative power, notwithstanding Joe's comments about the worries about the implementation, coming up with a common approach to reference scenarios, and every central bank I speak to says they're waiting for this, is potentially very, very powerful. So give us a flavor. What can you tell us about where you're going and how it's working?
Yeah, you're right. So by the end of this month, at the end of June, the NGFS will publish a set of reference scenarios. As you might know, this is the work of the Workstream 2, which is being chaired by Sarah Breeden from the UK PRA. So to echo what Joe just said, Maybe we should clarify what we mean by scenario and by stress testing, because it may cover a number of different things, and not everybody agrees about what they mean by scenario analysis. As we see it, scenario analysis covers three kind of bricks, if you like. You have the scenario bricks. In particular, what you want to know is the pathways. What will the pathways to a low carbon economy? And in that pathways, what we're trying to do within the NGFS is to integrate physical risks and transition risks, which is extremely difficult. Usually you have some scenarios for transition risks, you have some pathways which are already available, and you have some other kind of analysis for physical risks, but putting them together in an integrated manner is difficult, but this is what we're trying to do. So the NGFS will put on the table four scenarios, 3-4 scenarios, which are actually here to reflect various possible pathways to a low carbon economy. Possible because we believe we cannot forecast what's going to happen. So we're not trying to predict the future or to forecast, but simply to reflect some possibilities, some pathways. This is something that clearly the NGFS can work to further harmonize. But then it's not going to be enough to have a stress testing or a full scenario analysis, because what you will have to do is take a look at your own exposures, the exposures of your own financial system. And of course, it very much varies according to your economy, the energy mix of your country, the level of openness to trade, your specialization. So this part of exposures is not going to be harmonized because it very much depends on each country. And then on top of it, you also need to include the macro loop. What we mean by that is that beyond the direct exposures of your sectors, there will be some macroeconomic impact across the board that you have to reflect as well. And again, this macroeconomic impact will vary, again, significantly according to your economy. So what the NGFS will do is helping to standardize the transition pathways part of scenario analysis. And we hope, and we are quite confident that it will be useful to most central banks and supervisors around the world. But for the rest, of course, you will still have to reflect your specificities, the specificities of your economy. So there will never be a fully harmonized way of doing it, but at least on the scenario pathway side, we hope the NGFS can help to standardize.
So this is a complex piece of work going forward, and I guess it's going to be ongoing work. One of my fellow high-level expert group members, Miriam van der Schutzelli from Somo in Netherlands, is on the call, and she's just asked a question. She says, to what extent can you start looking, or have you been able to look at the impacts of physical or transition risk, as in social impacts, unemployment, poverty, the stuff that we're experiencing now as one of the first great shocks of the 21st century going forward, in your thinking?
That's a very good question. So you may remember, Sean, initially we were due to release this high-level transition scenarios in April this year. Mm-hmm. And actually, what happened, and so the experts who work on the scenarios decided to wait a little bit and to include in the scenarios the macroeconomic shock that we are experiencing right now. So that's why it's a little bit delayed, but we are reflecting that macro shock in the scenarios. But going forward, maybe last point I'd like to make on that, what will be published in June, this month actually already, it's not going to be the end of the discussion. It's a preliminary proposal, if you like, and the NGFS will continue to work on that and publish something more granular and specific, probably around November this year as well. So you will have plenty of opportunities to look at it and comment.
We're very much looking forward to reading that, Morgan, in due course. I must say that some of the kind of ideas in the paper on green and brown differentials, I suspect they're going to have a lot of read across with the scenario analysis, because I suspect what you're going to find is that a lot of the scenarios and stress tests will depend on there being the banks having a solid idea of what the underlying assets that they're holding in their portfolios. And for that to work well, they'll have to know and understand properly not just what sector these assets belong to, but also what the industries are what the activities are. Fundamentally, is this a renewable power station or is this a coal-fired power station? I noticed that the results from the Brown-Green work was actually saying that we're not really ready yet for this. But to take this forward, is the NGFS thinking about doing further work on developing brown taxonomies to have to go essentially beyond what we're seeing through the technical expert group in Europe, but actually working out some of the other brown sectors too?
Yeah, thank you, Prashant. So you may remember in the April last year comprehensive report, we have one of our recommendations, I think it's number 5, I guess, where we're calling for the development of a green and brown taxonomies, simply because this is something we experienced also in the status report when we asked banks or insurers to identify their exposures to specific sectors. Then currently there's no way to do that in a consistent and comparable manner. So we need a brown taxonomy at some point in time for the sake of risk analysis. Having said that, defining a taxonomy is a political decision. And many colleagues here who were involved in the discussion in Brussels are aware of that. And it's not, I would say, it's not the role of the NGFS to say this kind of asset or this kind of industry should be green or brown. All we are saying is we need a brown taxonomy, we need a green taxonomy, and also we need to have, in case there would be several taxonomies worldwide, those taxonomies should be made comparable and transparent so that we know what we talk about when we compare exposures on a cross-country basis. So we're not going to develop taxonomies, in particular brown one, but what we say in the report is that we need one.
Okay.
It was a decision of or rather a commitment from the trilogue discussion in Europe between the Parliament, the Member States and the Commission in December to develop a brown taxonomy. So Europe will be doing some work on that and we'll see whether it happens in other areas. But Joe, let's go back to your points, because one of the key points in your slides up on the screen was the concern about availability of reliable models. And I guess that links back a bit to scenarios as one of the modeling things. Tell us a bit more about these findings, particularly interested in short-term and long-term concerns.
Thanks. Well, I think it's interesting. If you look at the left-hand side of the chart, that shows the short-term concerns up to the next 5 years. And if you just look at the darkest bars there, the high significance, as Sean said, the availability of reliable models is the biggest concern for the largest number of the firms. But the second biggest concern is regulatory uncertainty. All of those concerns do ease as we go to the right-hand side, the long-term concerns beyond 15 years. I think it's quite interesting that regulatory uncertainty is then the highest concern further out. So there's something there about, the firms aren't completely confident that the regulators are going to be completely clear about their expectations, or maybe they're just not sure. So I think this is where groups like the NGFS can play a huge role. And, the report does talk about the need for supervisors to be very clear about their expectations. And I would absolutely reiterate that. In terms of, reliable models, they develop all new risks that come along. There's a kind of life cycle, if you like, defining it, developing the taxonomies, measuring it, mitigating it, all of that sort of stuff. And so that will just happen. The trick, I think, with climate, though, is to try and do it as quickly and efficiently as possible, because we don't have 20 or 30 years to get this right. We've kind of got to get moving. I think the other thing that's quite interesting to me is the lack of, or the bars there on internal alignment on climate risk strategy. So what this is pointing to is that even within firms, it's quite a struggle sometimes for them to get every stakeholder lined up and agreeing what the strategy ought to be. And I think that that's also where the supervisors can help, because sometimes, best will in the world, some people don't really get this and they don't think it's important. They don't think it's a priority. Actually, if the regulator says it is a priority, you tend to find that resources are suddenly committed to it. And that can be a way to trigger investment. So although I might sort of moan a little bit about the potential for regulatory, lack of coordination, if you like, I do think that the regulator can be a real force for good here as well. So, keep that in mind as well.
Challenge to you, Morgan. I want to move on now to possible solutions. Morgan, in the paper you did with Bank of International Settlements on Green Swan, great paper. One of the comments about that was now the need to develop the agenda for action, if you like. So Prashant, pick us up on this issue, which is ideas that have been thrown into the pot. Now, these are not necessarily on the NGFS agenda at this stage, although in some countries like China, where the regulator has taken a lot of quite aggressive steps to grow the market, some of these things are happening. Lead us through, Prashant.
Yeah, thank you, Sean. Yeah. I'm really glad that we can sort of spend a bit of time now just thinking a little bit about not just what we're doing so far, but what we could do. So what I've done with this slide is really sort of pick this from a report we produced last year called Tilting the Playing Field. And it's really drawing on what central banks around the world are on occasion doing, not always every central bank, but there's examples of pretty much all of these. The top line is really this whole disclosure agenda. This is about getting financial institutions to report on what they have done so far, what their assets are. We're also looking forward with stress tests and standardized climate scenarios about what kind of exposure they have in the future. And if I could try to sort of oversimplify a little bit, this is really where the NGFS effort is most focused. So some of the reports that we produced last week and coming out later this month are really about this first line. And these are tremendously important because it kind of sets the fundamental kind of architecture so that we can start doing further work. But it is important that we do further work. And what we've done with the three lines below there is really thinking about some of the other powers that central banks have, which go beyond just getting micro-prudential supervision to actually trying to make sure that they're actually helping the economic system develop so that it's more safe to climate change. So with the second line, we're talking about ideas where central banks are actually buying assets either through non-conventional monetary policy, QE, through staff pension funds, and through funds like the Hong Kong MA's currency stabilization fund. So in a sense, some central banks have got massive purchasing power as holders of assets. So I think in the paper we talk about QE, where literally trillions of euros or dollars worth of assets have been bought. And so far, the rules have been largely to do with being neutral about what kind of assets to purchase. But if they were tilted to buy green assets, that could have a tremendous sort of influence for generating more green assets, and it's probably depressing the prices of some of the brown assets, which will influence that. The third line is really to do with some of the kind of Basel Pillar 1 rules that central banks set, which are really the kind of assets that regulated entities have to hold in order to use as collateral for when they borrow from banks or when they want to demonstrate their capital adequacy. And this is the kind of debate that a number of us have been having over the years about brown and green adjustment factors. And I think in the latter part of your report, Morgan, you do talk about the regulatory toolkit. So I think the bulk of the report is talking about some of the kind of regulating transparency issues, but it would be interesting to hear your thoughts about why there is still hesitance about brown and green differentials. I know one of the things I noticed about the paper was the way it was argued was really looking at, from the historical record, what is the evidence that there is a differential credit risk from brown and green. But is that really the right way to approach this? I mean, if we were asking banks to look in their assets book a few quarters ago and see what the risks are to aviation or to cruise liners from pandemics, obviously they're not going to find any data, but it doesn't mean that these risks aren't real. And the fourth line here is some of the regulations that are more common in some of the Eastern economies. And this is ideas like lending quotas, where central banks specify that these are certain sectors of the economy which the country needs and which have to be supported. And this is particularly common in places like India and Bangladesh. And other ideas like interest rate discounts. I think as Sean has mentioned, this is something that PBOC has done for green assets in the past. So this is the kind of range of the toolkit that we could deploy. I'm really keen to hear when we can get this kind of stuff on the agenda. And I noticed from some of the questions that other people are sharing these kind of questions too. And maybe we could just go on to the last slide.
I think Sean's on mute.
Yeah.
My apologies. I was just going to say, as you can see, I'm still learning. In a paper that published in The Conversation recently by AFD, the French Development Bank, who coined the phrase that central banks are the new guardians of the forthcoming chaos, which I thought was a nice turn of phrase. They're calling for banks to green their portfolios, green QE, repo transactions to reward virtuous issuers, and so on. And I thought that was interesting that this is a French government agency, of course, but dealing with emerging markets. So I think we're going to see a lot more push on that. You know, I appreciate Banque de France has been one of the more forthcoming about the need to do this, but you've got a global community of central banks that you're dealing with. We fully understand. But yeah, what do you think, Morgan?
Well, thank you. If you allow me, Sean, I would like also to bounce back on one point made by Prashant in his presentation. It's about this question of risk differential between green and brown. What we say in the report is not that there is no risk differential, is that what we're saying is that we cannot measure it now. But ultimately, we hope over time, if we find a way to overcome the methodological obstacles, there should be a way to measure it. And logically speaking, there should be a risk differential somehow. It should materialize, in particular for brown assets, because at the end of the day, and this is something that Joe mentioned also earlier, the big problem is this mispricing issue. We really believed, and this is something that we were convinced at the beginning of the NGFS, that the market was not pricing climate risks appropriately for a number of reasons. And what we see from this report is that it's probably true, because we don't see any risk differential between green and brown, whether logically we should see one. So probably we'll see some, sorry.
Yeah, I mean, the really interesting thing about your report was, I think out of the 40, 50 banks, insurance companies that were surveyed, I think 5 had data where they could say that they'd done a bit of analysis on this. I thought, if I recollect correctly, some of the evidence on differentials is strongest for mortgages. So people with green mortgages, they do have slightly lower risks of default than brown mortgages. And there might be various reasons for this, and the Bank of England has posited some reasons, other people have posited other reasons. But the interesting thing was that the evidence on renewable assets was actually a little bit more equivocal. And there were good reasons for this. But I do return back to my earlier point that if you're looking in the fossil record of data, you might not necessarily find evidence of Homo sapien, right? I mean, you know, just or Homo superior even. So, is the right question, you know, looking in the past for things that haven't yet materialized fully?
No, right. It's not. It goes back to a discussion that we had, I think, a few days ago. We also presented this report to a number of stakeholders, and the questions that they had was, are you going to do an updated version of this report in 1 year or 2 years' time? I don't think we will, actually, because this study is backward looking, and what we want to do is have a forward looking approach. So clearly this is what we observe from the past. It doesn't give us a clue, but going forward is certainly not the right way to continue doing it. And we hope with you know, the upcoming stress testing or climate scenario analysis exercises that will be carried out in some countries in the UK and France, we hope that we're going to have more info. And this is precisely the objective of those stress testing exercises, to give us a little bit more insight using a forward-looking and dynamic approach to risk, and not only taking a snapshot of the past exposures in a way. So I agree, in a way, I fully agree with you, Prashant.
I'll take you to your next slide, Prashant.
Yeah, I mean, I pulled this slide out really because Joe gave some really fascinating insights about what banks and some of the other financial players are doing. This slide is actually taken from a bit of work that Climate Bonds has done, and my colleague Caroline, did an excellent survey of treasurers, people who have actually issued green bonds in the past few years, and asked them what was their motivation when they first considered issuing green bonds. Now, what you're seeing here is overwhelmingly on this kind of 1 to 6 scale, the main reason for this was actually market-driven stuff. So all the bars in blue are things that where the market is already rewarding green bond issuance. And I think it's some of the points we've heard earlier about. These are kind of some of the green finance products are innovations. There's actually a market out there. The market's asking for green bonds and some of the other new kind of financial instruments. Reputational benefits is also highly regarded. So some of the issuers and the people actually producing these underlying assets that we all crave, they actually see reputational benefits from creating renewable assets, green homes, whatever. The curbing climate change is the one in green. Again, that's a major kind of reason for why people are doing the issuances. But look where public policy and regulation is, right at the very bottom, the red one at the bottom. So at the moment, I'm afraid the evidence that we're picking up is that the regulators, the financial regulators, government more generally, I suspect, is not seen as driving the issuance of these brand new green products. I'm just wondering when it is that we're going to expect stock prices to rise because there's some kind of green bump to the share price because of regulations or some kind of financial incentive, or when policy and regulation actually forbids or strengthens green assets. And I find it a little bit sad from both what Joe has said and from what we're finding in our surveys that it's not regulation that's driving this, regulation is playing catch up. So just any thoughts about that?
And that might be a rhetorical question, but Morgan, Joe, do you want to add your thoughts to that? I mean, especially Joe, looking at it from both a regulator and a bank point of view, do you see this as going to be a catch-up exercise while the market's way ahead of the regulators, or what's your reading?
I think typically the market does move ahead of regulators. It's quite difficult for them to keep up with this. I also think, and it does play to the Green Swan paper as well, that there is a limit to what central banks and supervisors can do on this. We really do need policy, actually, and we need the price mechanism to work properly. We need those externalities to be priced because firms are operating, they're trying to maximize their profits within their existing paradigm, and they need to be pretty confident. I think they need to know that it's going to change. And so that needs public policy to be driving it. The other thing we haven't really talked about, though, is the speed of transition and the need for a just transition is absolutely critical here as well. So if you move too fast we get financial firms just dumping brown assets left, right, and centre too rapidly, that might bring about more financial instability than you might actually unleash something that's really quite harmful. So it's a delicate balance here, but I do think that supervisors probably are lagging the market. But I think that public policy has a huge role to play here. There's only so much that supervisors can do here.
Yeah,
Okay.
if I may, if you allow me, Sean. So thanks a lot for referring to the Green Swan paper. Look, I couldn't agree more. At the end of the day, what we need to have is clear actions from all parts. And as Joe rightly mentioned, we need to have clear guidance and time horizon. For example, on the transition and the pricing or carbon price, it's going to be this amount by this year and then this amount by this year, so that investors can kind of anchor this into their time horizon and investment behaviors. And also clearly other decisions like the phasing off period to exit diesel or to move from one technology to another. There is a clear need for clarity there and for a sort of a macro policy mix with fiscal measures, government decisions, energy policies, and of course financial stability and measures and monetary policy. But it's really a package.
We're going to need to wrap up. We're at the hour. I did have just one question to throw you, which came up at the audience. There's a lot of questions. We'll share these with you afterwards. Someone asked, should we, given what we've got to do, should we be focusing on the qualitative measures now rather than the quantitative and detail? For example, processes for governance at this stage. And the eye was on the boards of banks or other organisations. Maybe we need to be having better standards in that area. Is that the next step? Joe, this is your area of work in terms of how you manage risk appropriately, and processes of risk in organisations are critical. Do we need more in that area, or is it actually much more detail around scenario planning? What are your thoughts about the next stage?
Well, as I said, I think it starts with the board. And I think that setting out best practice, getting firms to learn from one another, absolutely critical. Of course, we've tended to look at financial firms. What they want is they want firms in the real economy to start taking this seriously, because the risks are ultimately in the real economy and they're just mirrored back to the financial system. So we've got to bear in mind that it's the boards in real economy firms that have to start thinking about their business models and making that transition, which is why I say, it's not just about supervisors and the financial system, it's about those other firms. And so the more that we can educate them and create awareness and help them through case studies, learning, training, risk education, whatever, the better. Because I think once you sort of get it, you think, my goodness, we really better get on with this. This is pretty serious and very, very urgent.
That's a great parting thought for us, Joe, I have to say. Prashant, parting comments? Parting thoughts?
Just echoing very much what Joe was saying. It is a matter of public policy first, and that's really the finance ministries and the departments, as well as the central banks, but it is all three. Qualitative is not enough, though. It has to be quantitative as well, because in the end, we've got to create the incentives, we've got to cost out what the implications are on the balance sheet, and then we've got to redeploy capital. And in the end, it's the real economy that has to be changed, not the financial economy.
Morgan, parting reflections.
Yeah, last word maybe on that. What we meant by governance is the following. We observed that in financial institution, you used to have the ESG guys on the one hand and the risk guys from on the other hand, and those guys, wouldn't talk to each other that much. And what we need to have is an integrated approach. Climate risk needs to be something to be discussed with the risk people, and not necessarily only within the ESG realm. And we have observed over the last month and years that there is really this integration of the two functions that is happening. And this is what we mean by governance, making sure all guys talk to each other. And of course, the example should come from the top, and the impulse should come from the top.
Thank you. Thank you, everyone, for joining us on this webinar today. We're in a crisis. We do need to understand that this crisis is not something entirely separate to climate change. Rather the reverse. The way we experience climate change is not with an extra few centimeters of sea level rise in Cairns on the Côte d'Azur. We experience it with volatility and shock. We experience it with some things like the fires in Australia at Christmas, where I was visiting, which were terrifying. An area the size of the UK seemed to be under fire at one point. We experience it with the potential failure of crops in some countries, as happened in Russia in 2010, which triggered problems around the world in food prices. And we will be experiencing it in pandemics, as predicted by the IPCC Health Committee in the past. So we've got to learn from this. And also, we have to learn about urgency. We have to learn that the tempo has to speed up. We have to learn that the challenge is material, very, very clear, near to us now. It is not something 30s out. This is the beginning, folks, of a 21st century of volatility. We're now in a race to stop extreme volatility, which we don't know what that looks like. That's way beyond the bounds. And that's the 50% cut in emissions in 10 years. The work of the NGFS, and I have to applaud you, Morgan, what you've done in a couple of years with this program is extraordinary. Of course, we're going to keep pushing you. We want to go faster, faster, faster. But at the same time, what you've achieved is extraordinarily impressive and important. The thing that I am most excited about that gives me hope is the extent to which the intellectual discussion at what I call the top of the tree, provides a normative framework for the planet, for economists everywhere. You know, when central banks are saying this, well, I don't care what you say in your School of Economics in Pittsburgh and Pennsylvania. This is the issue of our time. And that is something we need to fully appreciate and support and work to flesh out the agenda. This webinar will be available on YouTube. You can get it via the URL at the bottom of the page, clientbonds.net/webinars. As I said, it will be available in podcast on Google, Spotify, and Apple. This is the new age of low carbon communication. Let's make the most of it. Joe, thank you for your work. Morgan, thank you for your work. Prashant, and thank you for being with us today and being so willing to indulge in this conversational style. Goodbye, everyone. Until the next webinar, which we're having 3 of these every week, and we hope to invite Morgan to come back to talk about the scenario papers when they're out. Look forward to that. Thank you, everyone.
Thanks very much. Thank you.
With pleasure. Bye-bye.
Bye.
Bye-bye.